Welcome to the Deep Dive. Today, we're really plunging into strategic U.S. retirement plans, specifically for 2025. And we're focusing on you, our listeners, who might be high-income earners, self-employed, maybe business owners.
Right.
Our goal here isn't just to list accounts, but to kind of transform how you think about them, to turning them into like powerful tools for strategic tax management.
Exactly. Cutting current taxes, but also setting up for, flexible tax-efficient income down the road in retirement.
Yeah, that flexibility is key.
And what's really fascinating, I think, is how these plans are so much more than just savings buckets. We're going to pull out some key insights from expert analysis today, show you how to use some basic tax ideas, look at the best plans for you, and even touch on some advanced strategies for building and keeping your wealth.
All right, let's unpack this. Maybe start with that really fundamental choice, that fork in the road.
Yeah.
Pre-tax contributions versus post-tax or Roth contributions.
Yeah.
How does making that call right at the start really shape your tax benefits, like now versus later?
Yeah. Well, it really boils down to what you expect your tax rate to be now compared to when you retire.
Okay.
So pre-tax, think traditional 401k. You get that tax deduction right away, lowers your taxable income today.
Yeah.
Which feels good, right?
Immediate gratification.
Exactly. But Roth contributions, you make those with money you've already paid taxes on. Big payoff. Qualified distributions later on are completely, totally tax-free.
No tax at all on the back end.
None. So, that difference, tax-deferred growth versus tax-free growth, that's really the engine inside these accounts. It's deciding when you want that tax advantage.
So for you listening, the high-income earner, the business owner, you want maximum savings, you want flexibility.
Yeah.
What are some of the standout options we've identified?
Okay, well, for anyone self-employed, the solo 401k it's arguably the most powerful tool out there.
Really? Why is that?
Because it lets you contribute in two different ways. You contribute as the employee, potentially maxing that out, and as the employer through profit sharing.
Oh, okay. So 2 bites at the apple.
Exactly. That dual structure means really high contribution limits.
Wow.
For 2025, we're talking up to $70,000.
Wow.
And if you're 50 or older, get this. Catch-up contributions can push that potentially to $81,250.
That's huge potential savings.
It is. Plus, it's unique because many solo 401ks offer a Roth option, which isn't typical for SIPs, and you can often take loans from them, unlike an IRA. So yeah, much more flexible than, say, a SEP IRA, especially if your income isn't super high yet.
Okay, sticking with powerful tools, sometimes ones people don't fully appreciate for retirement. The health savings account, the HSA. People hear health and think medical bills. But it's called a stealth IRA or even super IRA. What's the secret sauce there for retirement planning?
Ah, the HSA. Yeah, it's fantastic. Its power is that triple tax advantage. It's almost unmatched.
Triple tax.
Yeah. 1, contributions are tax deductible, lowers your income now. 2, the money grows tax-free inside the account. And 3, withdrawals for qualified medical expenses are completely tax-free anytime.
Okay, deductible in, tax-free growth, tax-free out for medical.
Got it. But here's the retirement kicker. After you turn 65, you can pull money out for any reason at all. If it's not for medical, you just pay regular income tax on it, just like a traditional IRA.
Oh, interesting.
So you get all that tax-free medical benefit potential, and then it just becomes another tax-deferred retirement account if you don't need it for healthcare.
Yeah.
It's a crucial piece for boosting overall tax advantage savings.
Right. Okay, now, a common hurdle for high-income earners, those MGI limits, modified adjusted gross income limits, for contributing directly to a Roth IRA.
To income caps.
Yeah, you earn too much, feels like the door slams shut. Is there a workaround, a way to still get money into that tax-free Roth bucket?
Yes, thankfully there is. This is a really common question for you folks. The standard play is the backdoor Roth IRA.
Backdoor Roth, okay.
So the basic idea is you make a contribution to a traditional IRA that you don't deduct a non-deductible contribution. Then, pretty quickly, you convert that money into a Roth IRA.
Seems simple enough.
Well, there's a potential trap. It's called the pro rata rule. The IRS basically looks at all your traditional IRA money together. Traditional SEP, simple IRAs, all in one pot.
Okay.
If any of that money in the pot is pre-tax, meaning you got a deduction for it earlier, then part of your Roth conversion becomes taxable. It gets complicated.
Ah, so you can't just isolate the non-deductible money easily.
Not if you have existing pre-tax IRA funds.
Yeah.
But there's a clean solution. The reverse rollover.
Reverse rollover.
Yeah. If you have a 401k at work, you can often roll those pre-tax IRA funds into your 401k before you do the backdoor Roth conversion. That empties out the pre-tax IRA pot.
Clears the decks.
Exactly. Then your non-deductible contribution is the only thing left, and the conversion to Roth is completely tax-free.
Clever. Okay, so that's the back door. But then there's something even more powerful, maybe, for people with employer 401ks.
Yeah.
The mega backdoor Roth IRA. Sounds impressive.
It really can be. So this depends on your specific 401k plan details. Two things need to be allowed.
Yeah, what are they?
First, your plan has to allow after-tax contributions. Now, this is different from Roth 401k contributions. This is additional money you put in after taxes beyond the normal employee limit.
Okay, after tax, non-Roth. Got it.
Second, the plan needs to allow in-service withdrawals or conversions of that after-tax money, meaning you can move that specific after-tax money out, usually into a Roth IRA, while you're still working there.
Ah, so you don't have to wait until you leave the company.
Right. If your plan allows both, you can potentially funnel tens of thousands more into Roth accounts each year, way above the standard contribution limits. We're talking potentially filling up the overall 401k limit, which is much higher, with Roth money.
Wow, so that could seriously accelerate building up tax-free assets.
It's one of the most effective ways, absolutely. You could potentially add, another $40,000 plus into Roth vehicles in a given year, depending on the overall plan limits and your own contributions.
Okay, so bringing this all together, what's the big takeaway for you listening? It sounds like the best strategy isn't just picking one plan.
Definitely not.
It's more about strategically combining them, right?
Mm-hmm.
Like maybe you're maximizing a solo 401k, you're fully funding that HSA every year, and you're doing a backdoor Roth IRA.
Exactly. That kind of multi-pronged approach gives you the highest possible tax advantage savings, and crucially, it gives you diversification against whatever tax law changes might come down the pike. You have money in different tax buckets.
Like assembling your own financial dream team.
Something like that. And looking bigger picture, it's really about using every single tool the tax code gives you to build a more secure financial future, especially when future tax rates are, uncertain. Now, because this stuff can get complex and everyone's situation is different, talking to a qualified financial professional, a CPA or financial advisor who really gets this stuff is always a good idea to tailor it just for you.
Absolutely.
Yeah.
So maybe the final thought for you to consider is, looking at your specific situation, what combination of these tools, the solo 401k, the HSA, the backdoor strategies, could unlock your most tax-optimized retirement? Hopefully this deep dive gives you a great head start on figuring that out.